Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. Now, if you've just joined us for the first time, a massive welcome. Congratulations on starting your investing journey. If you feel like you're just getting up to speed, then we have a podcast called Get Started Investing that will really get you...
Get started.
Yeah, that'll get you... that's it, Ren, you've said it. It'll get you started. So go and check it out, Get Started Investing. Now, my name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Good to be here.
Thank you for saving me there.
No, that's all right. We've just come off a great interview with Andrew Walker. If people aren't familiar with that name, they may be familiar with his blog, which definitely is big in the FinTwit community. Yet Another Value blog.
Yeah, it's one we've been tracking for a while now. And this was a great interview. Andrew's deep into value investing, and it's always good to get the views of a value investor in times like we are, and particularly coming off the back of decades of, well, not decades, but at least a big decade of incredible growth.
Like for growth stocks.
Yeah, for growth stocks.
Yeah. Not incredible growth for value stocks.
No, for growth stocks. Yeah.
And he mentions we speak about the change that value investing has undergone over the past few years, or the past few decades. And I feel like a lot of investors start their investing journeys being told to read The Intelligent Investor or Security Analysis, if they're really brave, by Benjamin Graham. And that leads itself to a certain type of value investing, the nets or Warren Buffett's cigar butts. But that strategy isn't as effective as it was back in the day. And Andrew talks about how he approaches value investing today. And we speak about some of the industries and some of the companies he's investing in, some surprisingly contrarian takes. Cable companies, US cable companies. You would have thought that Netflix was disrupting that and people were cutting the cord of cable over in the US, of Foxtel here in Australia. But Andrew has a contrarian take. So that was a particularly fascinating part of that conversation.
Yeah, it was a great discussion. Now, before we jump into it, it's worth mentioning that tomorrow is the end of financial year, and we currently have a sale on our Value Investor program that we've done in collaboration with Owen Raskovich at Rask Australia. It is all about value investing and gets you into the nitty-gritty of analysing and valuing companies. Now, it's an incredibly detailed and resource-rich online course with plenty of downloadable resources, videos, podcasts, plenty of written content, checklists, you name it. Currently, there's $100 off. It does end tomorrow, 30th of June. You just need to use the code EOFY at checkout. We'll put the link in the show notes, equitymates.com/online-courses, but the link will be in the show notes. And remember, code is EOFY for $100 off. By the end of the course, you'll have a great grip on how to analyze and value a company.
Now, let's get to this conversation with Andrew. But before we do, a reminder that while we are licensed, we're not aware of your personal financial circumstances. Any advice is general, and any information is for education and information purposes only. But with that, Bryce, let's get to this conversation with Andrew Walker, portfolio manager at Rangeley Capital and publisher of Yet Another Value blog.
Well, Andrew, welcome to Equity Mates.
Hey, thanks for having me, guys.
Now, as we said off air, we always like to kick off our interviews with Equity Mates' daily business guessing game, Biz Nerdle. Are you ready to play?
I'm excited. I told you guys, I love games.
Okay, great. Today's quiz starts with clue number 1. Now, we're all playing this together. I'm the world's largest food and beverage company.
Okay.
So you've got Coke. They're pretty massive.
Yeah, Coke and Pepsi in the US.
Pepsi.
But I feel like it'll be the...
Nestle?
Yeah.
Yeah, Nestle is kind of where I was thinking too. In food and beverage, unless you go like, hey, you've got one of those things where who's the biggest companies in the world by revenue? It's the grocery stores or something, unless you've got the raw food producers. But yeah, Nestle's where I'm going.
No one would sell more food than Walmart. But you'd have...
I don't think that's where it's going.
I reckon Nestle.
All right, let's see how we go. Typing in Nestle, 3, 2, 1. We've absolutely nailed it.
Yes.
Is it 6 letters? We also didn't know if it was 6 letters.
No. So there's no letter count. You just type it in.
Okay.
It's absolutely anything. But now that you're across it, I expect that the streak for Biz Nerdle will kick off for you today, Andrew. You're on one. If all you need to do is go to equitymates.com/biznerdle and you can play every day.
Oh man, you add it to Nerdle, and then for a while I was in Talk Turtle. I just don't know if I can keep up with all this.
There's so many.
I feel you'd be quite good at this one. Anyway, yes, Nestle, headquartered in Switzerland. One of their famous brands is Kit Kat, and one of their more popular brands at the moment is Nespresso. The ticker is NSRGF. There you go.
There you go.
All right. Well, Andrew, we're going to kick off with a little bit about yourself. And if you can, we'd love to hear about...
the Nestle ticker is also NESN.
NESN, there you go. Is it dual listed?
We'll need to take that up with the question writer here.
Is it dual
or
listed?
Or ChatGPT.
Or ChatGPT.
Yeah, it must be.
Must be. So anyway, Andrew, to kick off, are you able to tell us and help our audience understand what your journey to date has been in finance?
Ooh, that's a broad one. Are you looking for like background, or I'm kind of? Do you want me to just walk through my resume, or what do you guys like to hear?
Yeah, this is a job interview, didn't you know?
Cool. Okay, so I am a portfolio manager and the head of research at Rangeley Capital, which is a fund that was launched by my kind of partner Chris Demuth in 2008. I joined in late 2015, and then we are a small, scrappy shop, and part of our marketing and just, one of the nice things about running a small shop is you can do only things that you really enjoy doing for the most part. You've got a lot less compliance burden than if you're at a really large shop, and I love it. It's part marketing, part love. I also write and run what I like to call the Yet Another Value empire. So I've got yetanothervalueblog.com where, I write, comes and goes, but I try to get at least one post a week out. And then I host a competitor to you guys, the Yet Another Value podcast, where once a week, I try to have a very sharp investor on. And it's much different than what you guys do, where all we do, I don't care about their background. I don't care about, I don't care about anything except, hey, did they do really good work on an idea? And we're just going to dive deeply into one stock idea. And, my thesis there is, hey, this is a sharp person. Most of it are small hedge fund managers or kind of people writing stock-focused Substacks. This is a really smart person. They've put their money into this idea. I'd love to hear them explain it to me and do my research for me. So those are kind of the two things people might have heard me on, or maybe they'll subscribe to going forward.
I have been familiar with Yet Another Value blog for a number of years. When we were first introduced, I didn't know that you wrote it because... I guess I didn't put two and two together. So I'm excited to have this conversation.
Look, if they're video, I've got branded merchandise. Yet Another Value. This is the podcast.
Nice.
Send some through. We'll give it to our audience.
We also have branded merch. Maybe we'll have to swap some after this.
You guys are international. Get out of here. We're not paying international shit. Next time you're in New York, we'll do it.
Yes. Yeah. You mentioned there that there's a marketing element to it, getting your name, getting your ideas out there. But I'd love to get your thoughts on why you started Yet Another Value blog, what the value of it has been for you as you build your career and I guess build your name in finance. Bryce and I are big believers in learning in public, and there's real value in making the mistakes and asking the dumb questions. So I guess how's it been for you being so public with your investing journey?
Yeah, look, it can be hard because when you're wrong, there will inevitably be 1,000 people who will come on and say, you're wrong, you're the stupidest person in the world. And you've really got to worry about, and we can talk about this later maybe, but you've really got to worry about commitment bias, right? Like commitment bias, where you go and you write something and you plug into something. And I have certainly had this issue before where you're very publicly long something and maybe your thoughts start changing on it and you don't want to sell because you feel committed to it because you've been so public on it, or you can't incorporate new information because internally and externally you felt the pressure where maybe it's something we'll talk later. I am at Cable Ball. I'm starting to get a little bit more nervous on cable for X, Y, and Z reasons, but you kind of can't fully incorporate it because you've just been so publicly at Cable Ball, or maybe you just started ignoring it. I guess a lot of people who rode some of the great tech growth names from 2020 and 2021 up, 50, 100 times and then never sold. I think a lot of them would say with the benefit of hindsight, hey, I just got too publicly attached to it. I couldn't look at it and say, hey, risks are coming. It's overvalued, all that type of stuff. But it is marketing. A lot of times now, like if I go to a conference or something, like the value investing community is small. A lot of people have read it and know me. It's always nice to be known and like have that going. But look, the big benefit to me is I go and I put out an article or a piece and I say, hey, here's what I'm thinking. And, smart people read it and they'll respond and they'll say, hey, you're completely missing this. You're completely wrong because of XYZ reason. And I can go look that up and say, no, I still think I'm right. Or, oh, I am missing that. Or, sometimes I'll put a piece up and I'll say, hey, I'm bullish on this. And somebody will respond, yeah, you're bullish, but you're not bullish enough because of ABC reason. And I'll be like, oh my God, so it's been fantastic just in terms of the feedback and the community. And, especially with the podcast, there's so many people I've met through the podcast and the blog, but so many people I've met who I'd never would have met before. And I've made a lot of friends. Value investing is a very lonely game. You are reading, you're spending most of your time reading 10Ks and listening to earnings calls. Like there's not a lot of communal building, and the blog has really helped me network and find people. And I've really enjoyed it.
Nice. So you've obviously been in markets for a while, writing a lot about it, thinking through it. How would you define your investment philosophy and the area of particular focus for you?
Oh man, I feel like it changes all the time. At heart, I am a value investor, right? I want to buy $1 for 50 cents. That's what everybody says. And that's what I want to do. Right. But I do think a lot of value investors, and this was me for a long time too, right? Like when I first started, I wanted to buy micro caps. I wanted to buy nets. And maybe it's because they didn't work for a long time, but I do think there is something to, hey, in the 60s, you could just go buy things quantitatively and do really well. Right. You could go, a lot of people didn't even know what price to earnings was, right? You could beat it on that. In the 80s and 90s, you could beat things with pure speed, pure interpretation speed, right? Like I think those in the 2000s, 2010s, I think those are dead, right? Like I don't think you can buy nets anymore because computers buy nets, and anything that trades for net, it's generally doing it for a reason. Like you're applying a quantitative screen and there's something that's better at quantitative than. Now I'm generally trying to buy $1 for 50 cents, and I'm trying to do it because there's something I'm seeing that the market's missing, and it can be pure panic. In March and April in the banking sector, it was absolute pure panic. People were selling these things down like crazy, some rightly, and I think some wrongly. So that's a very topical one that's recent. It can be because the accounting's really quirky. Like some of my best investments have been, oh my God, like the financials look like an absolute disaster, but guess what? All of the debt is non-recourse. So when you zero out all the recourse debt, like the holding company is actually going to be okay. And the stock's down 95%. And sure, the company lost 50% of its value, but 50% is still there because a lot of the debt is non-recourse. That's a popular one. Another one that I've seen, and these are tougher, but like one big one I had was, are y'all familiar with Bob Evans? You're from Australia, probably not. You'd have to be probably Midwest US. But Bob Evans was a restaurant chain, right? And it's just like a down-home restaurant chain, kind of like Cracker Barrel, maybe. Cracker Barrel fans will probably get mad at me for saying it, but they serve good, hearty Midwestern food. And this was a brand that dated back to, I think, like the 30s or 40s. So they've been around for a long time. They had about 200, 300 mainly Midwestern-focused chains. Every sell-side analyst who covered them was a restaurant sell-side analyst. The CEO was a restaurateur. All of the board of directors had restaurant background. Well, Bob Evans launched this line of mashed potatoes, ready-to-eat mashed potatoes, right? And they were very popular. They were sold in Walmart. They were sold in a lot of restaurants. And ready-to-eat mashed potatoes are actually kind of difficult to. First, you need a brand, but they're also kind of difficult to make because they expire, right? It's not like you're selling like a pack of dried mashed potatoes that can last on the shelf. Like they have an expiration date. They need to stay refrigerated. So as they went, they had like the largest thing, and it was a pretty nice niche. They had distribution. They had built everything out. You had to mash millions of potatoes every year. They had a good brand. It was a really good business. So it was a consumer packaged business with a moat. Guess what? A consumer packaged business with a moat trades for like 15 times EBITDA. And a restaurant business that's, it's fine. It's been around for a while, but it's a restaurant business, trades for like 5 times EBITDA. And the CPG business had grown to the point where its earnings were more than the restaurant business. So you had this company that was run by a restaurant person. Everyone who followed it thought of it as a restaurant company. But when you looked at it, you'd be like, hey, not only are you earning more from the CPG side, the CPG side's like 3x more valuable than the restaurant side. You're a CPG company, not a restaurant company. So everyone valued it as a restaurant company, but you would go look at it and say, hey, it's a CPG company. And all of this is a very long-winded way to say, like, one of the nice things is when you look at a company and everybody else thinks it's kind of a duck, and you look at it and say, no, it's not a duck, it's a golden goose. And that's a place where you can find a lot of value as well. Oh, and then one more, and we might talk about this later, cable. You know, when I got into cable in 2017, this kind of comes back to the panic thing. Everyone looked at cable as a video distributor, and cord cutting was rampant. I'm sure everybody's very familiar with the dynamics around the legacy pay TV bundle. And if you looked at it, and there was actually a proof point, and we can talk about this later with cable, there was a proof point that video actually didn't matter. Guess what? ESPN, Disney, ABC, all these guys. Who is it in Australia? The big sports is the Big Ten. Am I remembering that correctly?
So we've got Fox Sports, which is owned by Rupert Murdoch as well. So similar dynamics.
I thought there was a Fox Australian Big Ten or something. But either way, like those guys actually take so much profit that by the time cable covers like paying those guys, plus the marketing, plus the technical overhead and everything, they don't make a lot of money on video. So everyone was terrified of video, but it turned out video didn't really matter. All the revenue and not all the revenue, all the profit was actually in the broadband business. So everybody was terrified of this video thing, and the broadband business was growing. They was taking price and everything. So you could get a business that was priced as a declining, dying business. But actually what was happening was the revenue was shrinking, but it was profitless revenue that was shrinking while the other side was actually growing. So that's another one where people were panicking about one thing, but if you really did the work, you could have kind of a variant view. So again, I've rambled there. I've got a podcast. I like to talk.
It's fascinating. Let's keep talking about cable, and then we can jump back into value investing and markets today a bit later, because it's a really interesting conversation. And you mentioned before we started recording that you have some holdings in the cable sector, which surprised me, because the narrative that, you know, as you sort of explained, the narrative of the last decade has been Netflix has disrupted, and there's a lot of cord cutting, and we're at a point now where if you sign up to all the streaming services, you're probably paying more than you would have for cable back in the day. So as consumers, I don't know if we're any better off. You know, Bryce and I were just in the US, and a big thing that I noticed was that these streaming services are coming for linear TV and for sport now.
Let me just. All you've talked about is the streaming services. Video doesn't matter. Video does not matter to any of the cable.
Let me because
okay.
So Amazon is now pushing into sport. They've got Thursday Night Football. We saw YouTube TV is now pushing into like linear TV and broadcast and stuff like that. So I'm interested to know like where you see the future of cable now that they're pushing beyond video into some of these other areas.
Well, so everything that you mentioned, again, video for the cable companies doesn't really matter. Everything you mentioned is actually interesting on the future of media, and especially sports media, right? Like who's going to be we've got a writer strike in the US. You mentioned Netflix. What happens to the legacy cable bundle? How do people get movies going forward? What happens with the sporting rights? All of that's interesting. Here's the question. How does that get delivered to the consumer? How it gets delivered is broadband. And what all of these cable companies have realized is, hey, the video business is extremely cost intensive and difficult. We don't really have a moat over it anymore. What they've realized is, hey, let's just, the people can, we can partner with YouTube TV. We can partner with all these people. Let's just deliver them broadband, which is very profitable. The first one to realize this, and this is kind of how I got my start in cable, was there's a company spun out of Graham Holdings, which was the Washington Post. Warren Buffett famously was with the Washington Post. When they sold the Washington Post, it became Graham Holdings, Graham being the family that was kind of the controlling shareholder of the Washington Post. Graham Holdings in about 2015 spun off Cable One, which is a rural cable provider in America. And Cable One said, hey, we don't think video matters at all. And you can go look through the old Cable One decks, and they had these things where they said, hey, video, people look at it and say it's 33% gross margin after you pay ESPN and ABC and all these guys. But what actually happens is, after you factor in the customer acquisition cost, sending them the set-top box. The only thing people really call the cable, not the only thing, but most of troubleshooting calls to the cable company deals with, hey, this channel's dropping, all that type of stuff. After you factor all that out, video isn't profitable. We're not going to worry about video anymore. We're just going to focus on broadband. And Cable One, it spun off at like $400 per share. And in 2021, it was trading for like $2,000 per share. So it was a 4 or 5x over 5 or 6 years. It was a fantastic story. So that was the one that a lot of cable investors looked at and said, oh, all these cable companies have been saying, oh, I don't know about cord cutting. It doesn't matter for the cable companies. And, John Malone, who formed the biggest cable company in America, TCI, he's a absolute legend in media and telecom investing. When one of his tracking stocks, he named Liberty Broadband. That's the tracking stock that owns about 25% of Charter, which is the second largest cable company. He didn't name it Liberty TV. He named it Liberty Broadband because all that matters is broadband. So, I think when you talk about all these Amazon, it's all very interesting. I'm happy to talk about the future of media, but we're not talking cable. We're talking about the future of media when we're talking about
that's fascinating. And I guess one thing that has already become a theme in this conversation, both with the mashed potatoes and now with cable stocks, is like a divergent view on from consensus being like a key part of being a value investor today. So I guess then the question is, if we're just looking at these cable companies as broadband providers, then really I guess the competitive threat is from other ways to deliver internet.
Yes.
So then how do you think about, you can't have an investing conversation without finding a way to get Elon Musk in there. So how do you think about the threat from Starlink and, new ways to deliver internet, 5G, is that a competitive threat? How do you think about all of that?
So that is the most cable investors today, not all, but most, like 5 years ago, everyone was worried about cord cutting. And I think there were a lot of us who said cord cutting didn't matter, and it worked out really well. And today, everyone is worried about alternative forms of competition coming into the market. And SpaceX and Starlink are one, but I think most people are pretty okay with that. There was an article that really made its way around in early 2021. They had a quote from a Canadian consumer who said, I got Starlink and I'm the happiest I've ever been with internet. It's so great, all this sort of stuff. And people said, oh my God, Starlink, satellite internet, all that. Satellite internet's been around for a long time. It can work really well rural, but in terms of delivering suburban and urban, you just can't get the bandwidth. And that's going to come back to right now, the big worry for cable is fixed wireless, which is 5G, basically internet getting delivered. T-Mobile and Verizon have taken a decent bit of market share with actually, it's still very small in terms of market share, but in terms of the growth, basically every internet broadband ad that's been in America over the past year pretty much has gone to a fixed wireless player. So, growth for the cable sector is down because this fixed wireless is taking just about every incremental sub. So there's a big question mark there. A lot of people, myself included, I just come back to first principles, and look, the stocks have done poorly over the past 18 months. So in the short term, I've been pretty wrong on this. I think in the long term, I'll be borne out. But I come back to first principles. The best way, the most consistent, fastest, cheapest way to deliver something is always going to be with physical infrastructure, literally with fiber into your home, light signals going from your home, from the router in your home, across the light signals to wherever their plant is. Cable is basically, at this point, fiber. It's not fully fiber, but the end game for a cable is fiber. Cable is literally fiber from their plant to about 100 feet away from your home. And then there's a coax cable that runs 100 feet from there so that's cable. It's pretty much fiber to the home. I just think that's the fastest, cheapest way. And one of the things I looked at, I did a post a long time ago, you can go back to 1999 and you can find advertisements from AT&T that said, hey, 2G is coming. It's going to be great. Ditch your dial-up internet. Come join the 2G revolution. It's the fastest speed you'll ever need. Guess what? It wasn't. You can find it for 3G. You can find it for 4G. This has always been there. This threat's always been there. And it's never really taken share. This is the first time it's actually taken share. I think part of why it's taken share is because T-Mobile in the US bought Sprint. They bought the third and fourth largest player, merged. And right now, T-Mobile has a ton of excess spectrum. And what they're doing is they're using fixed wireless to fill up all this excess spectrum. But the consumers' demand for data is basically limitless. It grows 20 or 25% every year. And eventually, that excess spectrum is going to be filled up. And then once that happens, what's the cheapest way to get extra capacity? It's to be the person who's got literally fiber to the home in there. And I think you see a lot of acknowledgments, both from T-Mobile, the cable players, all that, hey, eventually that's going to fill up. And once that happens, they're going to have to start turning players off. Oh, and then the last thing I guess I would mention, sorry, again, I can ramble, but if you look, a broadband person, if you have cable broadband, you probably pay $50 to $65 per month to get your cable broadband in America. That's 500 megs, 200 megs, something like that. If you have wireless, you probably pay about $65 per line. That is a slower line with less speed and less reliability. You probably have both. About 80 to 90% of your data is actually going to go over the cable line, not the wireless line. So if you just think in terms of cost, 90% of your data is going over the cable line for about the same cost as the 10% of your wireless data. If you think about a wireless player saying, hey, let's go grab that wireless, put it on our spectrum, like what's the best use of their incremental spectrum? Is it to go grab one cable player, or for the same economics, kind of go grab 9 mobile players? It's probably the mobile in the long run. So I just think in the long run, the physics wins.
Love it. Well, Andrew, are there any particular stocks that we can go away and have a look at or research in the cable space?
So my favorite has always been Charter. Charter is 25% of it is owned by John Malone, the legend of cable investing. It is the second largest. Cable player. They have in my opinion, they have a very shareholder focused mindset. The best cable company in America is probably Comcast, but Comcast unfortunately has NBCU. It's controlled by Brian Roberts, who is a little divisive. He bought Sky, which might have got him some. I don't think that got him any Australia, but he bought Sky. Like I think he has a little bit of a empire building mindset. He wants to play in the media space. Like Charter is just pure play focus on cable. As you and I are talking, Charter trades for about $330 per share. And one of the things with Charter is they incentivize their management teams to be shareholder friendly. So when let me back up. Charter was formed when they bought Time Warner Cable, Charter, and Bright House Networks, merged them all together to form the second largest cable company in America. This was about 2016. At the time, their CEO, Tom Rutledge, they gave him a pay package. Charter's stock was about 100, and it said, hey, if over the next 5 years, Charter hits $300, $400, $500 per share, we're granting you all of your options for the next 5 years up front. They only vest if the stock hits $300, $400, $500 per share over 5 years, right? So the stock has about triple for him to hit these. Now, if they hit them, guess what? You're going to be worth a lot, because options that have a strike price 3x out of the money, they don't cost a lot. And once you hit them, he would kind of be about a billionaire is kind of the thing I came out to. And guess what? He ended up hitting all of them. I think the highest tier, like he kind of hit and kind of didn't. Anyway, so that was 2016. Rutledge retires at the end of 2022, becomes the executive chairman of Charter. His CFO takes his place as CEO. In February, they grant the CEO, Tom Rutledge, and the CFO, they grant them another, what I call the all-in 5 years equity grant package, right? And in order, I'm looking at, I built a data table. The lowest end of these is by 2026, the stock has hit $507 per share. So from today, the stock has to appreciate at a 17% annualized IRR to hit the lowest end. If he does not hit that end, he gave up 5 years worth of equity comp for nothing, right? My thing would be, hey, I think the board and him looked at this and said, these are very hittable targets for you, because I don't think you give up 5 years of equity grants just to hit I have to do everything perfectly, just hit the low end of that. That's the low end. The high end is $1,000 per share. And that would vest if by 2028, the stock would have to do 26% annualized at the high end. So I look at a company where I say, hey, they've got all these competitive advantages. They're super shareholder friendly. They have a history of granting aggressive equity prices and hitting those targets. They've done it again here. They've dialed back the share buybacks a little bit for reasons we can talk about, but they do buy back shares pretty aggressively. They bought back about a third of their shares since they did the big merger. I think they've got a really nice wireless business, which we can talk about the wireless business. But I just look at all of these things and I say, hey, as we're talking $330 per share, I think this is a spectacular multi-year opportunity to compound wealth.
Well, we are going to take a very quick break, Andrew, and then on the other side, we're going to get your views on value investing today and then also current market conditions. So we're going to take a quick break. We'll be right back.
So, Andrew, before the break, we were speaking about the cable industry, and it's a fascinating look at the industry and a way of looking at it that I hadn't really thought of. And I think, as I said earlier, you mentioned with the Bob Evans story as well, today value investors really shine when they have a differentiated view to what the market consensus is. If it's cable, if it's mashed potatoes, whatever industry it is, it's sometimes hard as an investor to differentiate when you have a contrarian view and when you're just wrong. And so how do you manage that with the positions you take, the theses you build? How do you test them? And then how do you, I guess, monitor them and get out of a position if you realize I was just completely wrong about this?
Man, that is a really good one. I could have saved myself a lot of pain and a lot of red numbers if I knew. I don't know. One thing I try to be pretty religious about. So I do a lot of event-driven investing, and I'm trying to get better. Like, I think a lot of my biggest losses, especially over the past couple of years, have been you buy a company, the stock goes from you buy a company at 15 and they're undergoing strategic alternatives, and you think this is a really strategic company, right? You think it's cheap. You think there's going to be a lot of buyers, all this sort of stuff. And then they announce and they say, hey, we're not going to sell ourselves. We think we can realize more value as a standalone company. And the stock goes from 15 to 12, right? And you look at it and you say, oh, well, I thought it was cheap at 15. I still think it's cheap at 12. And now I'm just here, like, I've got this great undervalued company. I thought it was cheap. It's even cheaper now. And I think that's one where I have traditionally had a lot of losses, right? Like, sometimes it can work out. Sometimes everything works out. But in general, once you've done that, hey, I was here for the event, I was here for a sale, and it's morphed into a long-term, would you have been in it? Would you have been in it as a long-term investment without that sale? Probably not. You probably weren't in it before they announced. You probably have companies you like for me, I probably like cable better as a long-term compounder with less risk, more growth, all that. So I think that's one, never let a trade become an investment is one thing I think people said. I think that's one. The other is if you follow a company, you talk to management or don't talk to management, just follow a company. A lot of times if you go back and you read, when I'm doing research on a company, I'll read probably their last 6 earnings calls. And when you do that, it's really interesting to see how the company talks, because if you talk to the management, then they'll lay out the story, what they're doing. But if you go back and read the last 6, you can see how the story has changed over time. And I guess for me, what I'm trying to say is, if you buy a position, they announce bad earnings or something, the stock's down 20%. A lot of times, if you really hold yourself to the fire, you'll see hey, I was here because I thought this company was going to build new stores really accretively, and that was going to create a lot of value. And now the company is missing numbers. They're not going to build new stores. They're having inventory problems. I guess just holding yourself to the fire that way. But it is tough, right? Because for every story you've got like that, it's hey, the stock goes from 10 to 5, you double down at 5, and your thesis ends up being right. It was just the market being scared, and it goes to 25. That can be how legends are made, right? So it's very difficult.
So we are obviously going through a bit of a market rally at the moment, and it's hard to tell which side to kind of sway. Is the worst yet to come, or is it behind us? Taking that contrarian angle, do you have any contrarian views on the current market rally that we're going in, or how are you thinking about markets at the moment?
Markets probably overall neutral or maybe a little bullish. I hear you, we're having a bullish rally, but if you look at the Russell 2000, so I kind of benchmark myself to that, which is, for the Australian listeners, it's the Russell 3000 are the 3,000 largest companies in America. The Russell 2000 are the 2,000 smallest of those 3,000. So that's generally the lowest market cap would be, I think, about 100 million, and the highest market cap in that would be 4 billion. So you're not talking about the Apples, but you are talking about a broad swath of small to mid-sized American businesses. As we're talking today, I think it's still down about 20% from its peak in November 2021. So even though you've had a rally. It's mainly been concentrated in the largest cap companies. I still think there is a lot of value out there. Like aside from Charter, which is about $100 billion company, like most of the companies I look at are on the smaller side, and I still think you can find a lot of value there. And then, from a contrarian angle, I think the most interesting things that I've been looking at recently are the banks on the heels of Silicon Valley and First Republic going down. There are a lot of banks that are trading at or under tangible book. I think a lot of banks got shot with the held to maturity issues. What Silicon Valley and First Republic had were very rare. There are very few banks that have that much held to maturity issues where they were actually negative equity. I mean, there are some that their equity levels are a lot lower than I think the regulators would like, but there aren't a lot that are just like instant zeros. There are also very few banks that could survive like a complete run on the bank. It doesn't matter how much equity you have if all of your deposits are gone and you have to sell everything. But I think banks at or below tangible book are really interesting. A lot of them trade at approaching global financial crisis level valuations. The index has really underperformed. I had a post a few weeks ago. It was down like 40% on the year while the Russell was flat. At the global financial crisis, the regional bank index was down 50%. So you were kind of like 80% of the way to a global financial crisis valuation there. It's interesting because you've got equity markets hitting new highs. When you look at these regional banks, a lot of people are worried, what if we have a recession, all this sort of stuff. It's like, well, the equity markets certainly aren't worried about a recession right now. The banks are pricing in recession plus crisis. So I think that's one really interesting area right now.
The number of small banks in America, we had read about it, but when we went over to the US, especially walking around New York, you just see all of these shop fronts for banks that you've just never heard of before. And it's very different to Australia, where we do have smaller banks, but our market is dominated by 4 major banks. In a lot of ways, we're quite similar to Canada in that it's just like big banks dominate the market. There was a lot of fear, obviously, and then it feels like very quickly it's just fallen out of the news, that story. At least sitting here in Australia, we're not really hearing anything about smaller US banks. Has the fear subsided, or has the media just lost interest? Like, what is it looking like in that industry and on the ground?
So for banks, I think the fear has largely subsided. I actually think the real panic in the banks was when Silicon Valley went under, and you can go read like all these banks' earnings calls. A lot of the banks have been at conferences since then. The week, I think it was March 12th was the week. All these banks saw like anyone who had uninsured deposits was pulling pretty quickly or making sure they had insurance coverage. But since then, I've actually been surprised at how quickly things have stabilized. And, a lot of times when I'll talk to investors, they'll be like, oh, well, what if we have another run on the banks or stuff? I'll be like, hey, if you didn't pull after Silicon Valley failed, like, are you really going to pull now? What's going to make you pull? Like, the banks have kind of survived that. Look, I think a lot of the crisis has passed. For most of them, there's still a lot of uncertainty. Again, you're buying banks at tangible book or under tangible book. So that's generally a pretty good time to buy. It does speak to there's fear in it. There is a lot of uncertainty, right? Like there are going to be regulatory reforms on the back of what happens to Silicon Valley. There's no doubt about that. Capital requirements probably going up. There's going to be liquidity. Like I do think Silicon Valley taught investors, hey, in 2008, 2009, if you had to run on the bank, it took weeks, right? Because you had to go literally queue up outside of a bank, wait for a teller to get you your deposit, wait, all that sort of stuff. Silicon Valley lost billions of dollars in deposits in 24 hours. I think banks do have questions around liquidity that they have to answer going forward. Returns will probably be a little lower, but you're buying these banks at tangible book value or less. All of them have reserved for a mild recession. So you've already got these banks have been positioned for a recession. They've seen the commercial real estate issues coming for a year for the most part. Like what banks really need to solve stuff is time. And these banks have had a lot of time to prepare for a lot of issues. So I think you're getting a wide swath of banks at pretty attractive levels today.
Now, Andrew, we can't go past the fact that we're in the midst of a huge AI bubble and there's hype everywhere about it. We'd love to get your thoughts on how you're approaching the AI hype, I guess, with your value cap on. Is it a void completely, or are you finding opportunities? How are you thinking about it?
Just crying myself to sleep at night that I'm not long in videos. No, buying AI stocks in that is not really my game. If there was something I thought that had an interesting angle, I certainly would take a look at it. I do kick myself. There was this company that I still have a small position in, but I largely sold out of, called Opera. I'm not sure if you guys are familiar with that, the browser company.
No, I haven't heard of it.
I bought it a while ago on the thesis that a browser could be really interesting. They're the small company. They had all these dynamics around it. And the stock performed really well. The business performed really well. It had some interesting hidden assets in there. They monetized the hidden assets for less than I thought, but the business performed better than I thought. So the stock did really well. It's hard for me to kick myself. But I think in like March or April, they put out a press release that said, we're introducing the world's first AI browser, and the stock kind of hit my price target. And I was like, all right, I'm out. And somebody was like, hey, this could catch a real AI bid. And I was like, nah, it's a browser company. I followed this for a long time. There's no way. And sure enough, the stock's like doubled, just like straight line up since then, which kicking myself. But yeah, look, I do playing the AI games, not really for me. One thing I have thought a lot about, and I'm trying to, is how to use AI to get better as an investor. And I don't mean like in terms of quant, I think like Renaissance Technology, Two Sigma, all those guys, they're the ones who are going to win in terms of quant. They've been doing that for years. But, can you use AI to read a 10K better? Or could you put your top 10 stocks in your portfolio into an AI and it could say, hey, based on these, like, here's 4 more stocks that you might want to research as an idea that have similar characteristics that you might not be thinking about. Or, hey, like your top stock is Charter and your second top stock is JP Morgan. JP Morgan shares X, Y, and Z qualities with stocks that you've historically performed really poorly with. And Charter shares ABD qualities with stocks that you've historically performed really well with, like that type of stuff. And I haven't found anything that's like really great. Most of the investors I've talked to who like kind of like me are like 1 or 2 man shops, really fundamental value focus. The most I've heard is they use AI for like an improved Google or an alternative to Google, which is nice. It improves productivity, but I haven't heard anything like that really blows my mind in terms of AI use yet.
Yeah, neither. Like we've been playing around with it from a media point of view.
Am I even talking to you guys, or are these AI bots that you created?
I did actually try and train an AI to replicate my voice, but it sounded like a computer voice.
Y'all can steal this idea from me if you want. One thing I thought about doing, and I decided it was kind of creepy and maybe too. Tell me what you think, but like you could create a Warren. You know how you can create like a Van Gogh bot or an Obama bot or something that respond. You could create a Warren Buffett bot, and then you could do a podcast where you interview Warren Buffett. And you guys actually might be uniquely suited because you're 2 hosts. So one of you could be the interviewer and one of you could be Warren Buffett. I thought that would be interesting, like an AI Warren Buffett interview, but eventually I decided, kind of not my game, but yeah.
Leave it with us.
Yeah. It's a dystopian idea when you really go down that rabbit hole too deeply, and then it's like...
It is, but no one's done it, and like hopefully the 3 of us are good guys. We do it in like a nice, respectful way, but you could do it. I'm sure it would get a lot of interest, and it would kind of teach you how you could use AI, and mainly the interest thing is what you could use it for. Yeah, you also, I don't know.
Maybe we could slander Warren Buffett so much that he feels compelled to come on the podcast and refute the allegations against him.
You've got to watch out. So for my April Fool's post, I put up an activist letter to Berkshire. And if you read it, it was extremely clear it was joking. So first, I misspelled Buffett throughout the letter. I used 1 T instead of 2. And like one of my top recommendations was, hey, Warren, you keep all of your money in cash. That's so stupid. Look at Silicon Valley Bank. Silicon Valley Bank was one of the best performing stocks of the 2010s for banks. And they kept all their money, like they took all their cash and they put it in long-term treasuries. Go get that yield, buddy. And I intentionally clipped it because like Silicon Valley Bank was one of the best performing stocks from 2011 to 2021. So like Silicon Valley Bank had just gone to zero. There was no chance I was being serious about this. And I got some really hateful emails from people. Like one guy I had to respond to and be like, hey, you need to look yourself in the mirror, buddy. But the Warren Buffett fans will come for you if you slander Warren Buffett.
Well, we were at the Berkshire conference this year, and it was 45,000 glowing fans, like just in love with these 2 90-year-olds. So yeah, let's not piss them off.
No.
Hey, yeah. I love them too, but you've also you've got to be aware of your heroes' shortcomings too. They do have shortcomings.
Absolutely.
I mean, those 2 have made a lot of people millionaires, maybe even a couple of people billionaires. Yeah. So there's no surprises.
Oh,
that
definitely a couple of people billionaires.
Yeah.
The sneaky Buffett billionaire. I mean, like 4 years ago, the first Berkshire buybacks they'd done, maybe ever or in a long time, was they bought from the estate of one person who had just like. He owned $2.1 billion worth of Berkshire shares.
Really?
So
Oh my God.
I think there's like 3 or 4 others.
Wow.
Must be nice.
Anyway, Andrew, we have reached the end. It's been great to chat. We do have a final question. Each year we do the Equity Mates Awards, which is an opportunity for our community to vote on the best expert or their favourite expert interview of the year. And by virtue of you coming on the show today, you're automatically entered into the award. It's an opportunity for them to just, give some feedback and let us know who they really appreciated coming on the show. To help them with the award, we'd love to know if you were to win the trophy, which is this beautiful glass thing here.
There's a trophy? My God.
We would love to know
prepared harder.
where would you put the trophy if you won it?
Oh. Does this influence the voting? Do people care where I put it?
It depends how good your answer is. It can really sway things.
Here's what I would do. You guys get me the trophy. I'm going to bring it to Berkshire next year. We're going to go on stage and I'm going to run the stage with the trophy and I'm going to put it right in front of Charlie and Warren and say, I am the Equity Mates expert interviewer of the year. Bow down to me. That's what I'm going to do. Everybody's going to see it on live international television.
Love that. Well, this is really going to help with your voting at the end of the year. We really appreciate it.
That was not a legally binding promise.
No, of course.
But if you do it, then Warren and Charlie will be aware of Equity Mates, and then maybe they'll hear our AI interview with them. So it all fits together.
Love it. Well, Andrew, thank you so much. It's been great to have you on today. I know that our audience would have taken a lot from the show, so we really do appreciate it. We'll include all the links through to your blog and podcasts in the show notes as well. So if anyone in the Equity Mates community want to check out what you're doing, then we will provide them with those links. But again, thank you so much. We do really appreciate the time.
Thanks for having me, guys. This was a lot of fun.
Thanks, Andrew.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.